Let's welcome on board Sunny Agrawal and find out what he's making of the market right now. Sunny, hi, good afternoon. Welcome to ET Now. Wanted to understand what's your take on the markets. How do you approach this kind of volatility, which really is gut-wrenching? And I don't think we've seen this kind of a move on the markets in the past many decades.
Yeah, good afternoon and thanks for having me on the show. Yes, definitely. I think markets are pretty volatile and the kind of tariff war which is going on, I think to some extent, definitely there is a breather for at least 70 to 90 days. And that's obviously give a lot of leeway to the government to negotiate with the US in terms of trade, tariff and everything. But I think overall, looking at the volatility, I think it's better to take a slightly longer term approach to the market, gradually deploy your capital over the period of next 3 to 6 months with an expectation that calendar year 26 and 27 are likely to be relatively better in terms of return. So I feel the strategy should be to deploy capital gradually in the market. Again, the focus continue to remain on a domestic consumption stories where basically earnings are likely to be better over the period of next 4 to 8 quarters. A case in point, we believe that BFSI as a sector is likely to fare well over the period of next 4 to 8 quarters. So NBFCs obviously being one of the key beneficiary of the ongoing rate cut cycle by RBI and liquidity infusion. Banks, frontline banks continue to look good from investment perspective. Domestic consumption stories, both on discretionary as well as staple side. Case in point, Imami, Godrej Consumer, Tata Consumer, Varun Beverages on basically staple side. And on discretionary side, hotels and tourism look good. So companies like ITC Hotel or Indian Hotel. At the same time, I forgot to mention Bharti Airtel, which is again part of consumption story. And in addition to that, airline companies, again, there is only one play, Interglobe looks good. Cement, which has not been doing well since last 1.5 year, kind of, there we feel that profitability is likely to improve during the quarter four as well as FY26. So cement looks relatively well placed going forward. And within auto, very selectively, we feel the tractor as a segment is likely to do well. So there we are focusing on companies like Mahindra and Mahindra, Escort, Swaraj Engine, and selectively in two-wheeler TVS Motor.
All right, so those are some of the sectors that Sunny is liking at this point in time. Very good afternoon to you, Sunny. Good afternoon to you as well as Kunal. And recent announcement, rather just an hour ago or so, where you had China that said that they're going ahead and actually hiking the tariff on the US imported goods, that is to 125% from 84%, though they're saying that now it doesn't make any economic sense at all when you talk about the tariff point of view. But Kunal, if you talk about India VIX in particular, it is set for the biggest weekly percentage spike this since March 2020. I believe the spike in India VIX over the last 1 week has been about 42% or so. How should one actually gauge all of this? Because the volatility doesn't seem to end.
Yeah, so good afternoon, and I think 46% to be precise is the jump in the India VIX so far this week. I think what matters over here is not just the percentage jump, but I think it's a level for India VIX because that determines the zone of fear or zone of where the markets go back into a state of calm. For example, I think a couple of weeks back we were discussing that how 35 VIX level for CBOE is an important trigger because once the CBOE VIX crosses about the 35 levels, we expect the markets to go into a sharp dizzy on the downside. For the India VIX, that level is around 18 mark, 18 to 18.2 approximately on the historical denotions when the India VIX had jumped up above the 18 levels. That's where we expect the markets to get into a state of a sharper zone of corrections or at least the sharp volatile moves. I think on an intraday basis, we managed to just about touch that 18 mark today. But assuming, say, over the next couple of days or starting the next week, if we drop below the 18 mark, I would believe that there could be a higher chance that the markets would become a lot more stable. I think what matters over here is that we know that this news flow across US and China would keep on happening, but the markets would not react to the same news on a similar kind of a stance. So there's bound to be a point where the VIX would drop down significantly, even though the news flow may remain or the direction of the news flow would remain more or less the same. I believe that would be a first indication that the markets would probably get back to a zone of stabilization.
Other than the VIX, Kunal, are there any sector indicators which also tell you that the market may be in for a rebound? Or would you say just keep your eyes on global markets and VIX?
Aisha, good question. I strongly believe that so far the banking and the financial names are the ones which are showing signs of absolute strength. So, even on a relative basis, for example, you look at the last, 1 week, 10 days, where there was, from end of March, start of April, you've seen heightened amount of volatility where many of the sectors, saw a fresh round of correction of 5% to 10%. In that time span, for example, the banking stocks have done, Bank Nifty, after a correction of almost 1,000, 1,500 plus points, we're back again above the 200 DMA for the Bank Nifty. Now, this comes at a point where the Nifty is still almost 5% lower than its long-term moving average. Most of the other sectors, whether it's energy, auto, FMCG, etc., are still trading sub their longer-term moving averages. This has been one sector, banking, in the financial services pocket, which is trading significantly above the long-term moving average. And I think that's a very strong indication that this is a sign of strength. So if there is one sector which could shield itself from the market correction and which has been doing it over the last few months, that's Bank Nifty.
All right, so that's the take coming in on Bank Nifty and how it's looking when you talk about the charts. In fact, that's also a sector that Sunny is liking at this point in time. But Sunny, let's talk about the sectors that are a total no-go at this point in time. Given the fact that there are a couple of them that everyone's watching out for, they are actually maintaining caution when you talk about the IT and the pharma space, given the fact what is happening on the tariff front. And, one cannot actually gauge what the sort of an impact could it be on either of these sectors. But apart from this, are there any sectors that you are actually not wanting to venture at this point in time?
Definitely, I think a lot of uncertainty on IT side, especially, and to that extent, we have already seen that stock prices has come off from their recent highs by 20 to 30%. But having said that, what I feel is that within IT pack, most of the negative is already in the price. So if you look at most of the large cap IT companies, they are now trading close to 19 to 23, 24 times trailing 12-month price to earning multiple. Free cash flow yield is now north of 3%. So I think downside, all the negative news is already discounted, and I believe that maybe for next 3 to 6 months there can be a kind of consolidation as far as large cap IT companies are concerned. In addition to that, again, one sector which is a global cyclical is metals, where because of a lot of moving parts, again, US being one of the largest consuming market, and China again a kind of producer and consumer. So I think till the time this trade war doesn't get settled, I think metals can be one of the sector where one can be very cautious in the short term. But within metal, what we feel is that relatively aluminium as a commodity is relatively stable, where we are seeing a kind of very stable prices as compared to the other commodities. So if somebody still want to stick his neck out and want to invest in metal, I think aluminium is the place to hide. So companies like Nalco and Hindalco can be on radar.
Hindalco have seen quite a steep correction as well of late. Any buy indicators on the charts?
Not really, Aisha. In fact, many of these metal counters are now actually on the verge of a further corrective wave. So, Nalco, for example, the stock has broken significantly below its previous swing supports. The stock was trading just around that 200 mark, just about till a couple of weeks back or 1.5 week back. But that stock is now broken substantially below the 200 levels. It's almost at 140, 145 mark. Same is the case with the other stocks on the metal pack. Even for example, large cap like Tata Steel, which is one of the stronger names. I think start of the month of April, when you saw that sharp crack from 155 or 160 levels thereabout for Tata Steel, the stock has fallen very sharply. And what this generally indicates is that these stocks would take a lot of time to try and get back into recovery. Because the month of March, when we saw the stocks recovering, was at a point when the risk appetite was making a comeback. Now, with such kind of news flow flowing around, the risk appetite may not come back on an immediate basis. That, I believe, could be a key indicator, where I would believe that the metal stocks would underperform.
All right, let's take a look at what the tire stocks are doing, the likes of Apollo Tyres, MRF, CEAT, because all of them were holding on to very strong gain since the word go. And also one of the primary reasons could be that CLSA has come out with a note where they've initiated coverage on the entire tire space, with Apollo Tyres being their high conviction outperform rating, while MRF, CEAT with an outperform rating. What they're saying that the sector is at the bottom of the margin cycle. The gross margins will improve on back of the softening commodity prices, and the sector is relatively insulated, especially especially when you talk about the impact from the US tariff implementation due to limited dependency on exports. So tire pack actually holding on to very strong gains in trade today. And that brings me to the next question, Sunny, because you did speak about the fact that you are liking selectively the auto space, especially in auto space. Tractors is what you're liking. But if you talk about auto ancillary space, will you look at the tire pack?
Yeah, definitely. As of now, it seems that input prices have corrected significantly, and that should augur well as far as gross margin expansion is concerned for the tire as an industry. Within tire space, I think I would like to focus more on C8 Limited, which is again where it's a predominantly catered to two-wheeler and passenger vehicle industry. And there is still some brand affinity when it comes to the two-wheeler as well as passenger vehicle. At the same time, of late, C8 has taken price hike. So I believe any input cost pressure will be taken care by that price hike. So again, C8 is one of my top pick within the tire space. I think another stock which one can look from a long-term perspective is Balkrishna Industry, where again, its dependence on the US is very low. Europe is slightly higher. In Europe, I believe that going forward, in case there is any recovery as far as economic growth is concerned, I think Balkrishna offers a very favorable risk-reward ratio at a current juncture. So Balkrishna can also be entered at.
As of Indian markets, yes, we are holding on to the positive territory, but cannot tell the same about the European markets or the US futures because they've caved in on back of the fact that US or rather China has gone ahead with additional tariffs on United States. They've raised the tariff to 125% from 84%, and they've said that it will be effective from April 12th onwards. So on back of that, you've seen the European markets as well as US futures react. We've also moved in tad bit lower from those elevated levels. Nevertheless, we are actually outperforming the rest of the world at this point in time. But we also have Arpit Beriwal joining us on the show right now. Very good afternoon to you, Arpit. And we're just talking about how the markets have been faring, what the VIX has been indicating for the markets. But what's your sense? Do you think that going ahead is the broader markets that will try and make an outperformance when you compare it with the benchmark indices?
Very good afternoon, everyone. So if you see overall, the broader market has been outperforming today. But from last couple of weeks, if you see the overall market, so Nifty is trading in a broader range between 21,800 to 23,300 zones, whereas Bank Nifty has been relatively outperformer. So our take is that going forward, as soon as we see some recovery in the market, Bank Nifty is the index that has to be watched out for, and that index is likely to be outperforming going forward. So if we talk about Bank Nifty, relatively this was the index that has fallen much less, and we have seen a good recovery in the banking overall stocks. So our view is that index is likely to outperform, and especially our large caps are relatively placed better as compared to the mid cap and small caps. So overall, our view is that large cap is likely to outperform, and within that, NBFC and banking space will be a key sector to watch out for. Bank Nifty major support is around 50,000, 50,250 levels, and till the time it sustains above this level, an upside move can be seen towards 51,500, 52,000 levels. Whereas talking about Nifty immediate support is 22,500 levels, whereas the upside, the major hurdle is 23,333. So overall, Bank Nifty is expected to outperform as compared to Nifty, and large cap is likely to be favorable as compared to the mid cap and the small caps.
Just looking at the performance of what really is happening on TCS, it's been a volatile ride, but the stock has already fallen over 20% in the last few months or so. So which is why you're not seeing such a steep reaction. In the last 6 months alone, if we can just bring up that chart for you, it's taken a knock of about almost 22%. Which is why if, you're not seeing such an exaggerated move, even though the numbers were disappointing. The company, of course, is very clearly slowing down. They've reported their lowest revenue growth in about last 4 years in the quarter gone by. And what's worrying is the employee addition, perhaps. Just 625 of a head count in Q4. They currently have a total of 6 lakh employees. Also, the fact that they said that they're going to be deciding on wage hikes during the year. It can be any time depending on business. Of course, a lot of uncertainty, which is marring the IT index or rather the IT companies, what with regards to discretionary spends in the US, which is why perhaps they don't have exact clarity on the kind of hiring that they will be doing. But a slight indication on if TCS has this kind of a visibility, what is it that you're going to hear from the rest of the IT pack? But let's hear out what the top management had to tell us post their numbers.
On a sequential basis, North America grew for us. Okay, there has not been a decline. That's why all major markets grew last quarter. Okay, but overall, see, like you said, the discussions on trade policies, actions, this space has been quite busy, and our customers are also trying to understand how it impacts them, and that's the reason you find some of the customers, particularly in the consumer business or airline, some programs have been paused and some decisions have been delayed. But at the same time, we have not heard any major program getting cancelled. I don't think there is any panic reaction amongst our customer base as well. They are watching this space and they'll wait for some clarity to emerge over the next few weeks or months. At least if you look at FY25 has been better than FY24. So at least we have delivered on one part of the promise. We still stay confident that FY26 will be better than FY25. See, like if you look at our order book, we announced one of the strongest order books without the support of any mega deals, almost $12.2 billion coming. Our pipeline remains strong. There is a fair bit of discretionary projects in that 12.2. So while I believe these uncertainties will settle sometime soon, and in the medium to long term, our business model is quite resilient. We see India as a huge growth opportunity. There is no reason why it can't be maybe as big as UK or Europe at some point in time. Okay, we are quite bullish on India, and India is a market that will continue to grow and continue to adopt technology in a significant way. And our strategy is to participate both in the public sector and the private sector, and help them leverage technology in as bigger way as possible.
Right. So that's the management of TCS actually talking about the earnings, the quarter gone by, what are they seeing actually ahead. But let's talk about Aditya Birla Fashion, because this one is actually seeing a good jump in trade today. Jefferies has actually initiated coverage with a buy rating on this one. They believe that the company is decisively shifting focus to profitable growth, and they have actually the company's decision to split the lifestyle brand also enables greater focus going ahead. But let me come to you, actually get your sense, Sunny, when you talk about this entire retail space, especially when you talk to the likes of Aditya Birla Fashion Retail and Trent, how do you see this space emerging?
Again, when it comes to fashion, I believe there is a kind of market difference in terms of performance by each and every individual company. On one hand, Trend continue to deliver a fantastic growth rate, but again, trading at an very expensive valuation. So we have seen some pull off as far as valuations are concerned on Trend. ABFRL, again, a portfolio of very robust brand, but at the same time, because of these over leverage balance sheet, we are seeing that EBITDA numbers are not going to the PAT, and that's the reason the company has undergone a restructuring process wherein they are demerging their lifestyle business, as well as they have raised multiple funds which can deleverage its balance sheet. So I believe ABFRL is poised to report a very healthy set of earning growth during the FY26 and FY27 period. So again, on valuation perspective, looking reasonable. Apart from ABFRL, I feel within this fashion space, Arvind Smart Space is trading at an attractive valuation. So there we have got a buy call as far as Arvind Fashion is concerned. Again, a very strong brand portfolio, and there we feel that the earnings can grow north of 25% CAGR over the period of next 2-3 years. So Arvind Fashion is our top pick within this retail segment.
That's that on how the retail universe is moving. But Sunny, didn't take your thoughts on IT. What did you make of what lies ahead for IT amidst all this uncertainty, listening into TCS's management?
Yeah, I think a kind of a mixed bag commentary as far as IT is concerned. So till the December quarter, we were hearing that the discretionary spend is back on track, and after the March quarter, because of this ongoing global uncertainty, I think there are some clouds as far as the discretionary spending is concerned. And at the same time, the deferment of wage hike by a large major like TCS clearly indicate that even management is not confident, at least from a short-term perspective, that what is likely to be the growth outlook during the Q1 or Q2 of fiscal year 26. I think definitely earning growth is likely to remain tepid, at least for the first half of FY26. But to some extent that has been offset by a very good TCV deal wins we have recently seen by TCS. But ultimately, street look for growth and a single digit or mid single digit kind of growth by large cap IT companies. So again, the valuations are something which will not be, so all these companies won't be getting a very significantly high price to earning multiple. So I think maybe wait and watch mode is the right statement for the large cap IT companies. For mid-size IT companies, I still feel the growth can be slightly relatively better. So companies like Cyient or for that matter Persistent, Oppo, all these companies can report relatively better growth during the FY26 and 27 period. So all these mid-size IT companies will be on our radar.
Okay, Sunny, good to have you on the show. We'll let you go on that note. Thanks for your thoughts as always.
If you like this video, then like, share and subscribe to ET Now.